Trideep Bhattacharya is joining us from Edelweiss PMS. Trideep, good morning. Thanks very much for your time. There's a nice rally which is kind of playing out. Do you think the near-term bottom is made now in the price, looking at the way India underperformed the world but was resilient, and now global macros, the key worries are improving or receding, those fears are receding, and the probability would be high that we have made the bottom, or you would not jump to this conclusion yet?
I think from a near-term standpoint, we have passed one flashpoint, is what I would say. And the flashpoint has been, and the troublemaker before that was the 10-year bond yield in the United States, which reached about 5% or thereabouts. And the reason I say we have crossed the flashpoint is that Fed has come and held the rates, and they said that, over the next 3 to 6 months, they would not look to raise rates. And that's kind of cheered up the markets for the moment, which is what you saw in the last couple of days of rally overall. But has the rate related worry completely gone away? My answer is not yet, maybe. Have we seen majority of the worries? The answer is yes. So for now, Diwali is on the cards.
Deep, which is the area of the market in your view which is where the risk reward is very attractive right now?
So my sense is that, I would take it the other way around. I would say that in mid and small caps, I do see some pockets of irrational exuberance coming about, which is why over the last couple of months, we have been actually in the portfolios that kind of cater to that. We have actually balanced our portfolios more towards large cap incrementally. So I would say amongst market cap basis incrementally, large cap offer a little better risk reward balance than maybe a small cap. And the need of the hour is to have a balanced portfolio across large, mid and small rather than a focused mid and small areas. In terms of areas where we still think there is valuation comfort, there are two areas that I would point to. But when I say areas, it still needs stock picking. First area that I would point to is lending financials. I think within lending financials, particularly within, let's say, select NBFCs, we think that net of growth, I think valuations are still reasonable. And over the next 1 or 2 years, there is good money to be made. The second area that I would point to is, growing IT services companies. In other words, IT services companies where we see a bit of growth coming through on every correction, they look quite interesting to us. So these two specific areas look attractive, where valuations are relatively more sanguine than that of others. Otherwise, there are thematic areas like, for example, the capex theme, and the company is exposed to that. I think that theme is still evergreen for the next 3 to 5 years. And the other space that we like is basically the direct and indirect plays in real estate. I think that's the other space where we think we're in the middle of an upcycle, and valuations in the context of the upcycle are still reasonable.
Trideep, Morgan Stanley this morning has come out with an interesting note saying time to get back into chemicals. In fact, they've upgraded Aarti, which is up 10%, and SRF up 5%, despite the fact that this is the most underperforming space in the last 4 years. Would you be selectively looking at chemicals? It is at the bottom end of the cycle or not yet?
So I would say that, chemicals today is where IT services were about maybe a year or so ago, where, they were overall from a earnings standpoint, they are seeing a downdraft driven that some of the earlier rise in commodity prices were reversing. And when those prices come off, their earnings get negatively impacted, which is what chemical companies are going through right now. And hence, the quarter's numbers that have come through for all the chemicals companies have been kind of weak to meaningfully weak. I would sign up for 3 to 6 months more of weakness to come through before an uptick really resumes. So I would be at the moment a little patient, but would get my thinking hat on to get my analysis done so that I am ahead of the curve whenever the tide turns. But probably not yet.
Right. Okay. What are the risks right now? Your friend Chris Wood says that there is a big risk of elections. If Mr. Modi doesn't come back with the same thumping majority, markets could fall 25%, but in the same breath says that dip should be bought. How potent is that risk in your view?
Yeah, I think that would be if that were to happen, that would be an entry opportunity of a decade. In retrospect, the same of the same level as we saw during COVID. If you could sort of utilize that dip come through. But I agree with him that volatility with regards to national elections will happen, and should there be change of guard, then there would be short-term volatility and whatnot. But actually, I mean, I'm not an elections expert and whatnot. What I would be, I think, incrementally more worried or conscious about is the US bond yield. In my opinion, I think the 5% in United States, and basically, if you ask me, the risk is the higher for longer, going on for a longer period of time, and the number of commodities going in that area has increased. So earlier it was bond yields. Now, of course, oil, courtesy the geopolitical scenario, is also could remain higher for longer. So if you ask me, what is the worry fundamentally, I would say higher for longer commodity prices and bond yields could be a worry for markets from here on.
Trideep, what has surprised me is that despite of high rates, real estate sector is at a multi-decade high. So if I assume that rates remain the same for 6 to 8 months and then probably start coming, would you make a case that real estate rally could have further legs?
It's a very nuanced and thought-provoking question, so allow me a bit of a minute to explain. The first thing that I would say is that the reason why the real estate sector has still remained resilient, it has to be seen in the context of what happened in the last 10 years. In the last 10 years, despite rates being low, we went through demonetization, we went through consolidation on account of RERA, and various different sectoral reforms which the sector has gone through. So in that context, the sector was meaningfully depressed, and hence, even though rates have gone up, the overall buoyancy on the sector is on the cards because of those structural reforms or the negativity of the reforms going away and people taking a fresh view with regards to the sector. So the structural bottoming out of real estate should be seen in the context of the rising interest rate. That's the first point. The second point I would argue is that overall, with regards to the inventory, all over India, if you look at the housing unsold inventory, this is a hard fact, it is at a 12-year low. And when that happens, no matter what the macro conditions are, the launches, at the same time, the buoyancy in regards to demand remains strong. So I think these two are very India-specific, very kind of sector-specific bottom-up data points which must be kept in mind rather than just following the rates and the linkage to the real estate sector.
Right. All right. Thanks very much for your time, Trideep.